I want to head over now to Bloomberg Radio Surveillance, where Tom Keene and Ken Prewitt are talking to Pimco's Paul McCulley. He's at the central banker meeting in Jackson Hole.
Yeah, it's a little perplexing. We have independence of central banks because we want them to be able to say no to the fiscal authority about inflationary type of fiscal expansion. But when you have a deflationary fat tail of the central bank, independence concept changes, and the central bank should be more cooperative with the fiscal authority. And the fiscal authority is not seizing the moment. And here, I might just give you my own opinion. As I wrote in that piece you were citing, Mr. Bernanke himself laid out that framework of a more cooperative stance between the monetary and fiscal authority way back in 2002 and 2003.
Well, Paul, everybody seems to be waiting to hear what Ben Bernanke is going to say at his speech tomorrow. And, of course, the last time he made news, he said the future was unusually uncertain. Would you like a little clarification?
Oh, absolutely, particularly in the context of the most recent data flow. And I think he will give us that type of clarification. Importantly, just how much the FOMC has marked down, or the Fed staff has marked down, it's a forecast for the 2011, because they operate on a forecast, not just real-time data flow, though the real-time data flow informs the forecast. So I think that's what we're looking at first and foremost, is the clarification on the forecast, and then two, some degree of clarity on how they would put together contingency plans for actually pulling the QE2 trigger. We have more confusion right now in the marketplace about the Fed's true intentions than we've had for quite some time.
Well, what if you don't get it tomorrow?
If you don't get it, I think the equity market will probably make a very loud noise in the negative direction. I think the equity market vigilantes are in charge right now, not the bond market
that's
vigilantes
interesting.
of old.
Go into that further. That's an important point. Equity vigilantes are doing more than bond market vigilantes?
Yeah, we think in terms of when the bond market vigilante phrase was coined by my friend Ed Yardeni about 25 years ago, and the predominant issue then was inflation was too high, and you actually had the Reagan administration running quite expansive fiscal policy. And so the bond market vigilantes back then would rebuke, if you will, policymakers for tilting in the inflation direction, whereas now, 25 years later, we're tilting towards the deflationary direction. So therefore, it shouldn't be government bonds that should be rebuking the central bank if it's pursuing a deflationary policy. It should be the equity market. And I think that's what we're seeing. So we've moved from a world of bond market vigilantes to equity market vigilantes, which would also include credit market vigilantes, because credit is of the same ilk as equity, just one step up in the corporate capital structure.
And Paul, critically here, this is a question we've been asking a lot. If we have these incredibly low rates, and they could even drive lower with your QE2 you're talking about, the size of it, when we reverse, do we get a gradual reversal of yields higher and prices lower, or do we get a jump condition, a sudden shock to the system?
You're asking me to forecast around two corners in many respects, because we haven't gotten the QE2 and we haven't seen its effectiveness yet.
I'm just trying to get you out to 2012.
Yeah, I think what the Fed would be praying, and we'd be praying for as well in the marketplace, that if you go to QE2, it will have some degree of effectiveness, perhaps getting us closer to that escape velocity for our economy, so as that we can function without government support. And then at that juncture, you could have a gingerly approach.
Well, that was Pimco's Paul McCulley. Interesting, talking about equity vigilantes. Speaking with Tom Keene and also Ken Prewitt on Bloomberg Radio Surveillance.